And I think it just shows you that people don't operate with independence. They operate with a bias. They think when something bounces, it's just dumb people buying, and that prevents them from jumping on with the buy. I mean, think about Palantir and Tesla. Netflix, they were all like retail stocks. I'm not trying to be snarky, but a lot of the people say, well, American exceptionalism's over. That's why I'm buying Germany, are the people that hated every rally here. And so they're trying to now create an opportunity somewhere else. We know crypto is a generational divide, because if you did the survey with someone under age 30, it's probably like 50% own crypto. But history shows pretty clearly it's people in their 20s and 30s that are driving all future change. Credit card spending shows their investment.
The 75% doesn't matter, in other words.
Yeah, or the 75% is going to flip to 75% own crypto.
The rise of the stock market has left many investors uneasy. Despite confronting a series of potential disasters, from intense geopolitical conflicts to the most aggressive Federal Reserve interest rate hikes in modern history, the S&P 500 has delivered strong double-digit returns. This resilience feels unnatural to many, with critics labeling the advance a narrow AI-driven bubble destined to pop. They see a market reliant on a single theme, vulnerable to any shift in sentiment. However, according to Tom Lee, this pervasive skepticism is not a warning sign. It is the clearest evidence that the bull market remains in its early innings, with cryptocurrency poised to become the next major driver of this expansion. Lee methodically dismantles the bear case, pointing to a market that has absorbed multiple economic kill shots, yet emerged stronger, with corporate earnings continuing to grow. He argues the average stock, when viewed through an equal weight lens, is not excessively valued, while simultaneously positioning cryptocurrency as the next frontier for institutional adoption. This combination of traditional market resilience, reasonable equity valuations, overwhelming investor doubt, and the emerging crypto transformation forms the bedrock of his conviction that we are witnessing a new financial cycle unfold. The generational divide in crypto adoption and Wall Street's accelerating blockchain integration create a perfect storm for digital assets to fuel the next leg of this bull run. Now, let's watch clips from Tom Lee's explosive interview to gain more insight. Please don't forget to like, subscribe, and enable notifications for more in-depth content. Thanks for joining us again. Enjoy the rest of the video.
I'd say, number one, just for people to place themselves like in history. So if you had a fact pattern of 20% gains, and then the third year's up 10 already, and maybe we'll be up 15 or 20 this year, then we're in a bull market. Like, so whatever.
What do you mean? Then you have confirmation that it's a bull market?
Yeah, because this never happens in a bear market. You can't have like
well,
a dead cat bounce that lasts 36 months.
You can't have bull markets and bear markets.
Yeah, but then they should then place themselves in history. This is probably more of an early start of a bull market. This one has been particularly reviled, I think, because one, the speed of the recovery has been so fast. As you know, many people rage sold in April because they're like, look, the economist told me 60% chance of recession. That's the same as a sell rating on the stock market. And they went to cash. They couldn't redeploy it because there was no pullback.
It was too fast.
Too fast.
Is that what creates a hated rally? Yeah. That phenomenon, people don't get back in fast enough?
Yeah, and I think it just shows you that people don't operate with independence. They operate with a bias. They think when something bounces, it's just dumb people buying, and that prevents them from jumping on with the buy. I mean, think about Palantir and Tesla. Netflix, they were all like retail stocks. Like someone was telling me the first time that they tried to buy Tesla institutionally, they had to bring in this like research firm from Oregon that wrote a report on Tesla. Okay. This is Jennison.
Yeah.
And like, that was the first time that research firm ever got called to go to New York to actually meet a hedge fund.
Oh, wow. Okay.
So like, you know, all the really big churns come because someone recognizes it, and it's not often like the crowd that recognizes it. I've started off my career as a stock analyst. Okay. So imagine we have a stock. Okay. Let's call it, XYZ. And we shot it full of holes. Like they should have been kill shots 6 times, right? Because every one of those was a kill shot for this bull market. And yet this thing.
What are the things? The inflation cycle.
Well, for COVID, number 1.
Fastest Fed hikes in history.
Yeah. And then the bullwhip chain effect was number 2. The fastest Fed hikes Well, the fastest inflation cycle in history, the fastest Fed hikes in history, the Trump tariff shock, and then U.S. bombing Iran's nuclear
Each
facility.
of those should have produced a bear market.
Yeah, should have killed the bull market or
Right.
even killed the economy.
So what does that tell you?
Just like you don't even have to know market history, just common sense. The United States is bombing an Iranian nuclear facility. Therefore, by the spoos,
Yeah, you never would
that
have
morning, nobody would do
If
it.
you asked me in January, I'd say, okay, we got a risk of a bear market.
Right.
Yeah.
And none of these things has produced a sustainable.
That's right.
We've had like bear markets, but not a secular bear market.
Yeah. So let's say that this stock was 16 times and we shot it 6 times over 5 years, like just kill shots.
Yeah.
And it grew earnings every year.
Yeah.
We would say the PE has to go up a lot.
And it hasn't.
It's actually lower. It's a cheaper market
It's
today.
incredible.
So I'm going to 100% agree
All right.
that AI,
we can close out. Let's do favorites. All right, go ahead.
that AI is the most important driver of the global economy. Okay. But where I think people make an inference mistake, okay, is that a theme driving the global economy has been systematic to the global economy since capitalism
It's
was
always
started.
this way.
Yeah, there's always been an industrial revolution.
Okay, fair.
And even in the 80s, the retail sector was the best group for 20 years because boomers were entering women were entering the workforce, and there was a baby boomer thing on retail stock. So that was a single theme of demographics. And like the internet boom was a singular thing of actually creating digital infrastructure. So like it's always been a story of the stock market. When you're in a big cycle like this, the winners are easy to identify because they have visibility, but it doesn't mean the losers are dead Matt. But for now, they're kind of untouchable. This should be a good stock picking environment.
This one, the ISM manufacturing has been below 50 for 28 months.
Do you care about this?
Yeah, why is
I do.
this bullish?
Well, because remember, this is actually one where there's no one making up the answers. Like this is a survey that's sent and people respond if things are better, worse, or the same. So it doesn't have any political bias. But if they're answering it in a negative sense, that means that they're cautious. So you can take their answer at face value. Yeah.
That's what you don't want this to be like a heavily bullish reading.
Correct. You never had a cycle peak when you've had ISM below. By the way, this is the longest stretch since 1950. When you have this pervasive caution in business, we're nowhere near a cycle. It doesn't get more unstable.
Okay.
You get a Fed that's dovish,
Okay.
which is cutting.
You're probably going to get that, if not now, but at a minimum by May.
Yeah. But then you need this third thing to happen. You need the excess spread on interest products to fall. Like today, if you're borrowing for a mortgage, it's normally only been at 160 basis points above the 10-year, or like 1.6%. So the 10-year's at 4.2. The 30-year mortgage should be 5.8.
But it's not.
But it's like 7. So there's excess spread on mortgages. But
Okay.
as soon as those other two things happen, I bet you that spread drops.
What is the source of that spread being so high?
It's actually hard to explain. Someone says that it's either banks worried about prepayment velocity, so because they're going to charge, so they charge an excess spread, or it's uncertainty about the value of the collateral. Like, can home prices drop so you have to charge a high rate because they're only putting 20% down?
Wait, the spread is high because they know that if and when rates drop, people are just going to prepay.
Yeah,
the
so
shit
you
out of
lose
it
money. Yeah, you're losing money.
or refinance.
Yeah, so the velocity hurts you.
Right. The
Yeah.
lenders don't want 10% of their customers saying, here's all the money, I'm refinancing lower.
Yeah, so
That's
they'll
not
make money.
great.
They want to make money on it for now on the current income.
Okay.
And then third is, of course, like the mortgage market doesn't have as much hedging and there's a QT. And so like it's harder to get spreads moved out. But for whatever reason, it's unusually wide. It's like 50 or 60 year wides. I think the simple way to think of it is like, I don't know, let's say there's 20 trillion of mortgage debt out there and like half is above that rate. That's 10 trillion times 1.6 percentage points. Like that's money in people's pockets. Plus, how many more people are going to get mortgages now that it's 5%?
I actually think the Fed has not kept rates this high for this long in a really long time. And once they appreciably fall, I don't care how bad the economy is, I actually think you could see the biggest mortgage refinance boom we've ever seen, like outside of the pandemic.
Yeah, so think about how much money that drives housing recovery and liquidity and people starting to upgrade their homes. Remember, like Home Depot said, the upgrade projects keep getting pushed out.
Lee bases his outlook on data that goes against the crowd. A major piece is the equal weight price-to-earnings ratio of the S&P 500, now at 25.9 times. That number is only slightly above the 6-year average of 16.3 times, which shows that stocks as a whole are not wildly overvalued even after the rally. This has come after the market survived 6 different kill shots, the type of shocks that normally lead to crashes. These included the biggest inflation surge in modern history, one of the fastest Federal Reserve tightening cycles ever seen, supply chains breaking down across the globe, and geopolitical shocks such as the U.S. bombing of Iranian nuclear sites. Instead of falling apart, the market held on, and profits continued to grow. Rather than being a weakness, this resilience is seen as a major strength. Another factor is the ISM Manufacturing Index, which has shown contraction for a record 28 months. That is viewed less as deterioration and more as a spring waiting to release. Once business confidence improves, it could trigger a wave of spending and investment. It also challenges the claim that only a few megatech names are behind the rally, since sectors like utilities, financials, and industrials are also climbing, fueled by the giant wave of AI spending across the economy. Let's go back to the interview.
Do you think that's the next bull market is housing? I don't want to say recovery because prices are okay. A housing activity recovery.
Yeah, it's like a rethinking of shelter because people will want to own housing, but they're too expensive. Like maybe there'll be new kinds of smaller homes being built or demand for modular, but people will borrow money to get a home.
Tom, are you worried about the labor market at all?
Yeah. I mean, because we know we're not tracking it correctly anymore because ADP probably tracks it correctly, but they don't seasonally adjust correctly. And then we know the BLS numbers are different. But overall, I think the labor market is softer. I also think there's a lot less hoarding. That's why there's no pricing power anymore, right? Companies were holding on to employees. Now they're just letting them go.
Like, why is it so hard right now? The economy seems to be good. The stock market's booming. I'm hearing this all over the place. I'm talking about business school kids that should be hired. A, are you seeing that anecdotally? And B, what do you make of that data? Is it something that could get worse? Is it a blip? Like, what do you think's happening?
I think it is a big problem. I mean, I think it's observable. It's like too many things that could explain it. Because one, the
AI.
AI means there's a huge mismatch because most people aren't equipped to do the jobs that are going to be in the future available for AI. Second, I think there was this oversampling of people pursuing like liberal arts degrees expecting a job. I mean, liberal arts education's good, but we have now a huge shortage in trade workers, like massive shortage. Like it's to such a degree that AI robots are doing jobs that normally were trade jobs because there's a shortage. There's no linear careers anymore, right? It's a very different future because AI, I mean, the market's pricing in 2 cuts between now and year end. I would say to me, 2 cuts make sense if the Fed realizes real interest rates are too high because tariff inflation is transitory. And so they should look at the break-evens and realize 4.5% Fed funds versus 2.5 is 200 basis points extremely tight. If you don't even think you're going to hurt the job market, it's clearly hurting the job market. We know crypto is a generational divide because if you did the survey with someone under age 30, it's probably like 50% own crypto. But history shows pretty clearly it's people in their 20s and 30s that are driving all future change. Credit card spending shows their investment.
The 75% doesn't matter, in other words.
Yeah, or the 75% is going to flip to 75% own crypto. Ethereum, number one, is where the stablecoin boom is taking place. 60% of it. So like this whole Genius Act, Besant says stablecoins are going to go from 250 billion to 4 trillion. That's an exponential demand growth for Ethereum.
They're replacing money market funds.
Correct. And it's dollarization and all that. Ethereum pays a 3% native yield if you stake it. So the 6.6 billion held of Ethereum is over $200 million in net income right now. The day we turn on staking, not only is there no debt on Bitminer, it's going to pay you $200 million a year in dividends.
And what do you do with that? Buy more Ether?
or we might just pay it out as cash dividends.
Where does that 3% native yield come from? Is that gas fees that users are paying to use ETH?
Well, it's called proof of stake. So Ethereum doesn't have a proof of work model where you're competing for a block reward. It's saying if you hold ETH and you agree to stake it and validate transactions, you earn the staking fee, which is 3%.
Okay.
So keep in mind that the Genius Act and then SEC's Project Crypto is the recognition that using blockchain makes Wall Street faster and more efficient. I've seen it at Bitmine because like when we get the cash, the minute it touches the blockchain, it moves we have much better visibility and it's much easier to move, to actually track the money. The wallets are all tracked. And this is like 1971 because in 1971, the dollar went off the gold standard.
Yeah.
And everyone said, oh, I'll buy gold instead. But remember, the dollar suddenly became a fiat.
Yeah.
And Wall Street innovated because they said, now we have a dollar. Let's make sure we can move the dollars efficiently.
You don't need to move bars of gold to match the movement of the
correct.
dollars.
So it created Wall Street, came out of that single act in 1971. So now, 2025, Project Crypto from the SEC and Genius Act is saying, Wall Street, take advantage of this new technology to make Wall Street a tech industry. But they're all choosing to do it, or the majority are choosing to do it on Ethereum. Ethereum is a smart contract platform and has what they call EVMs, Ethereum virtual machines. So you can do basically a lot of smart programs and contracts. That's where Robinhood is doing their stable coins, the tokenized products on top of Ethereum.
What is the current value of all the ETH in the world? How big do you think it could get? Because working backwards, that's what the 5% stake in ETH, right?
Mm-hmm.
Okay,
yeah.
so what do you think?
It's about 480 billion right now of fully diluted network value.
Okay.
But
is the supply contracting or not yet?
It's actually growing about 1%.
Growing
which is
1%.
slower than Bitcoin's inflation rate.
Okay.
It's actually a third of Bitcoin's inflation rate.
Okay. How big do you think that could be?
Well, I think that there is a very high probability, I'm going to say maybe even 50%, that Ethereum's network value will flip Bitcoin's.
For Tom Lee, all of the signals come together into one clear picture. This is not a late cycle bubble waiting to burst. This is the start of a sustainable bull market. The very disbelief and fear that many see as a red flag, he sees as the true driver of what he calls the most hated rally in decades. That wall of doubt, he argues, is not a weakness, but the very reason the market has more room to climb higher, because disbelief fuels momentum when strong data supports growth. His confidence also stretches into crypto, which he calls one of the biggest opportunities of the coming decade, built on a clear generational divide in adoption. Surveys reveal that nearly 3/4 of older investors still own no crypto, while younger investors under 30 are moving in with speed and conviction. Meanwhile, Bitmine Immersion Technologies has been reshaped into what is called a pure-play, non-leveraged Ethereum treasury. The strategy is to use equity fundraising to build a target stake of 5% of the entire Ethereum network. For him, this is not about speculation, but about Ethereum's real utility, its control of the stablecoin system, and Wall Street's official move into blockchain through projects like the SEC's Project Crypto and the expected FIT21 Act. He even predicts that Ethereum could one day overtake Bitcoin in overall market size, supported by its native 3% yield from staking, which he believes has the power to generate lasting cash flows and steady dividends for investors. To him, this represents more than just a passing trade or a short-term bet. In his view, it is not gambling on hype, but placing money into the very backbone of tomorrow's financial system. Beyond crypto, he sees the AI revolution as a long supercycle, spreading profits far beyond the handful of megatech names, lifting entire industries. His closing point is simple. This is not 2021 all over again. The broad market is still fairly valued. Corporate America has proven it can endure, and extreme caution in business means there is a vast amount of demand still waiting to be released. Crypto remains in the very early stages of its transformation, with regulatory clarity and institutional adoption about to drive the next phase. For Lee, the data shows one conclusion: we are not at the end, we are still early. Thanks for watching, and don't forget to like and subscribe.